All right, ladies and gents. So the next part that I want to look at is specifically the part relating, or the information relating to Rob. Okay, so we'll do this one in blue. So they say renewable optimum base limited, Rob, incorporated in 1995, manufactures and sells solar panels, inverters and batteries and related consumables to both private and commercial customers. The management of Rob followed an effective strategy of acquiring all businesses or business properties from which it operates, and currently owns 15 properties throughout South Africa. So Joe acquired 55% of the shares of Rob on the 1st of July 2017. Okay, so if we do it like this, current year end we know is the 30th of June 2019. Opening for the year is the 1st of July 2018. So effectively 2 years ago, we got control on the 1st of July 2017 of Rob. Okay, and for a cash consideration of 12 million bucks. Okay, so again, guys, I've set up an analysis for you guys on this. So here we'll then slot in the 12 million bucks as part of our consideration. Okay, and at that point in time, we obtained control in accordance to the definition of IFRS 10, and we had the following equity balances. Share capital, 200,000, retained earnings 17,320. So if we go check our analysis, 200,000, 17,320, both of those just directly off of the question. Okay, so obviously, guys, again, we know that this is a situation of control because the question has told us that we've obtained control. So from a consolidations point of view, we know it is 100% H, 100% S. So before we even carry on with this information, we go consolidate all Rob's figures. So PPE, 19,657, and investment property, 14,853. So if we go check the solution, if I can just find it. PPE for Rob, 19,567. And our investment properties, like we said, was 14,853. Okay, and then lastly, we had our deferred tax of 412,000. Should be here somewhere. Deferred tax 412,000. There we go. All right, so that, remember that those are the easy peasy marks. Okay, if we carry on with the information provided to us, the first thing they tell us is that all assets and liabilities were considered fairly valued except the following. Okay, so firstly we have a plant. So Rob owns a plant that was used in the manufacturing of plastics. Now Rob leased the plant to an independent third party on the 1st of July 2015. So if we go back to our timeline, we started leasing this, that's 2016, 1st July 2015. So I'm just going to put 16 there and 15 there. All right, on the 1st of July 2015, the carrying amount of the plant on the 1st of July 2017, which was our acquisition date, amounted to 3.7 million with the remaining useful life of 20 years. The fair value at that date was 4.5 million. Okay, based on market-related rentals. And the agreement is as follows. In terms of the lease, our agreement is we start on the 1st of July. The question did tell us that, 2015. The lease date is for 10 years. We pay annually in advance. They give us the lease amount, 550,000, but they give us a market-related rent of 466. Now, again, guys, if you put yourself in the space of IFRS 3, so obviously if we're looking at IFRS 16, where we're talking specifically on lease accounting, we would take into account the terms of the lease. However, can you see in this particular case, we have an asset here because your market is only paying 466,000 for the rental of this property. but you somehow have landed yourself a contract where you are earning 550,000. So overall, there is a contract that gives rise to a favorable element, okay, which then meets the definition of an asset. Why? Because you have control over this asset, because you're the lessor, you own the property, and there are future economic benefits coming from that because you're getting higher than market rental. All right, so this present value of the favorable component of 500,000 is effectively the present value of this off-market component. So the benefit or the asset that you've gotten. Okay. So I know when we covered IFRS 3, we touched this very briefly in the class, but this is an example of where it can or does apply. So here in this particular case, we have a beneficial rent, a lease, a beneficial lease, which then gives rise to an intangible asset of 500,000. So if we go check our analysis, okay, you'll see here that I've included, or I suppose here, intangible on the lease. So your carrying amount is 0 because you would have not capitalized this in your separate record. Your fair value is 500. And of course, there is a deferred tax element on that, 28%. So your net after tax is 360. And that we've included then, I've again matched it up in color code for you guys. In the total column, as part of the value of your equity at acquisition date, we then have this 360,000 intangible assets. Okay. In addition to that, guys, we also obviously have the revaluation on the PPE itself. Okay, so the PPE had a carrying amount of 3.7 million. Fair value was 4.5 million. So if we go check our solution, okay, so the plant, 3.7 million, 4.5 million fair value. So our fair value adjustment is 800,000. Our deferred tax net 28%. So our net is going to be 576,000. So again, there I've color coded it for you guys. Okay. Okay. Just carrying on. Let me just deal with these two issues while we have them here. So guys, remember this off-market component on the lease. This lease is effectively signed for 10 years based on the question that they've given us. Okay, but we started this lease in July 2015. So there are, at this point in time, up until the acquisition date, there were 2 years past. So if you're going to amortize this favorable component, okay, you're going to have to amortize it over the period, or at least the remaining period on the contract. So like we said, the lease is 10 years, 2 years have passed, so we've got 8 years left on this contract. So our amortization for year 1 will be the 500,000 divided by 8, which then gives you 62,500. And year 2 also 62,500. And of course, there is the deferred tax on those. So if we calculate the total deferred tax, okay, we'll obviously have the deferred tax of the 140,000 that we would have raised, the liability on raising this particular asset. And then of course that asset gets realized. And so the tax, you'll then minus the tax on the amortization. I know, sorry, yes, there's depreciation. Let me just change this to amortization. Okay, so your total impact on your deferred tax at the end is then 105,000 rand. Now, how I've done this is I've split this up into 2 separate transactions just because it's easier for you guys to follow. You might find the solution a little bit confusing, but we'll get to that in a bit. Okay, same goes for the plant. So we said the plant, we're valuing the plant up by 80,000, and this plant has a 20-year useful life. So each year your depreciation is going to go up by 40,000, and of course there's the tax on that for 2017 year as well as 2018. So again, if we have a total of our deferred tax, it's the 224 liability that we would have raised at the acquisition date, and then we would have realized some of this deferred tax through the depreciation, or the excess depreciation coming through from there. So that then gives us a total tax of 201,600 rand. Okay. All right, so going back to the question, and here they tell you that this plant was classified correctly as PPE. So I know many of you are probably looking, and I know when I did this question, it stumped me as well for a while, because surely in the case where I've entered into a lease, I'm a lessor in terms of IFRS 16, and so I would de-recognize the asset and then raise a gross receivable. So initially when I attempted this question, that's what I had done because that's what IFRS says. But in this case, they specifically tell you that the plant is correctly classified as PPE. So they want you to keep it as PPE. In my opinion, not technically correct, but I suppose they gave you the information in the question to get to the answer that they were looking for. But just something to bear in mind. If you find yourself also being a little bit confused by this, just feel comfortable that you weren't the only one. Okay, so that effectively covers the plants. Let's have a look then at this factory building. Just going back to the plant, I think the only new thing that might have caught you a little bit by surprise is this, the present value of this favorable component. So how you look at it, guys, it's effectively an intangible asset you raise because you have a contract that yields you higher than what the market does. Okay. Right. If we look at the factory building, okay, so one of Rob's factory buildings was considered undervalued at the acquisition date, and the details are as follows. So the original cost was 3.5 and the accumulated depreciation was 275. So the carrying amount at that date would have been 3,500 minus 275, 3,225. That was your carrying amount, but they then give you your fair value, which is then 3.4 million. So there we will then have a fair value adjustment of 175 to get the 3,225 up to the 3.4 million. So if we go check our solution on the factory building, so we've got the 3,225 that I've calculated. The fair value is 3.4 million. So adjustment is 175. Like we had said, take out the tax and the adjustment, 28%. So your equity position is 126, and that we include then in the value of our equity at acquisition date. Okay. They then tell you that there is a residual value of 525 and there are 25 years left on this particular asset as at the 1st of July. Yeah. Now, what is interesting here is that Rob sold the factory to Joe for an amount of 3.6 million rand on the 1st of July 2018. So if we go check our timeline, so we obtained control here. We would have done the fair value of the asset at the acquisition date, and then 1 year later, we would have sold this to Joe at 3.6 million. So what we need to do is we need to calculate, okay, well, what is our carrying amount? Okay, so we know from a group point of view, the fair value was 3.4 million, and our depreciation for year one would have then been 3.4 million fair value, less the residual value that they gave us, which was 525,000, okay, from the question. And we know that there are 25 years available on this particular asset. Okay, so 3.4 million minus 525,000 residual value divided by 25 years gives you a depreciation for 2018 of 115. So our carrying amount at the end of 2018 was 3.4 million minus the 115, which then gives us a 3,285. We know that the selling price was 3.6 million, so we made a profit of 315. Now, you guys know that that profit is obviously it's an intergroup profit. It shouldn't be there, so we're going to eliminate it. So effectively what we'll do is we will debit the profit, credit the PPE. Yeah. But now, because the Joe is sitting with this asset in its records at an inflated number, Joe's depreciation is also going to be inflated by this 315,000. So how we calculate that is at the date of the purchase, we have 24 years left. Okay, remember, because if we go back to our analysis, right, so we had 25 years useful life as at the 1st of July, but this transaction happened 1 year later. So the remaining useful life of this asset is then 24 years. So the depreciation is effectively overstated in Joe by 13,125, which is effectively the profit divided by the 24 years. And of course, there's the tax on that at 28%. Okay. But at the same time, now this is where this becomes a little bit confusing because remember when we obtained on the 1st of January 2017, when we got control of Rob, we did a revaluation on Rob's asset. So we would have valued Rob's asset up. Okay, so that would then mean that there should be a higher depreciation charge. So remember, we did additional depreciation or we did a fair value adjustment at 175K. Now 175K over the 25 years gives you a 7,000 additional depreciation. So you'll see what I've done here in the analysis is I've said, okay, well, there should be a depreciation and higher depreciation charge because the value of the asset is higher. Okay. So again, I've just given you the total of the tax consequences here, which we're going to tie in just now to our solution because the solution's a little bit all over the place. But just to get a little bit of clarity, just to summarize what's happened at this point, we acquired Rob, we did a fair value adjustment, we valued the asset up. From that, there should be additional depreciation. Okay, so that's why we've only got 1 year of additional depreciation because at the end of that 1 year, we then sold that asset onto Joe. So when we sold that asset onto Joe, we then calculate what is the profit that has been made in that. And then we say Joe's depreciation is too high because that profit shouldn't be recorded in the books. It's a fictitious profit that's been created by selling an asset from one company to another. Okay. So if you can understand the chain of events, it makes it a little bit easier to figure out the solution that they've given you in this particular case. Okay. Then the last bit of information that they've given us in this case is an intergroup lease arrangement. Oh, sorry, these should be blue for Rob. So then on the 1st of January 2019, Rob and Joe entered into an arrangement whereby Joe leased an empty office from Rob for a period of 5 years. Okay. All right. The rental escalations are paid annually in arrears and were determined at $250,000 for the first year with an escalation of 6% per year. And the details are then as follows. Okay. Interesting, guys. Let's take a step back. Okay. For you to crack this particular solution, what you need to do is you need to say, okay, what has H done in its books? In this case, H, the holding company, would be Joe. Then the next question is, well, what would Rob have done in his books? All right. And then what we need to do is we need to say, okay, fine. If we look at these two together, what is the substance of this particular transaction? Yeah. So if we're looking at it from Joe's point of view, Joe has entered into a lease, okay, with Rob. So from Joe's point of view, he's going to have, you'll remember, talent from our leases class. So in other words, there'll be an asset, there'll be a liability, there'll be interest, and there'll be depreciation. Okay. From Rob's point of view, Rob is the lessor in this arrangement. And if we look at the information a little bit further, this is a lease of land and buildings. Right, so this will be an investment property in Rob's books, and Rob will then record this year on year at fair value. Okay. But now, if we look at this from a group point of view, the lease doesn't exist. Okay. So from a group point of view, this effectively becomes an owner-occupied asset. Okay. In which case, then we have I-16 that applies. Okay, so this is actually quite a very good question from UNISA because it tests not only I-16, it tests I-40 as well as IFRS 16 all in one. So what we need to do now is we need to, obviously they've asked us in this particular question to give the non-current assets. Okay, so we know Joe has a right of use asset that shouldn't be there, and Rob also has an investment property that shouldn't be there. So if we go do these calculations, and I've done it here in the question for you. So let's start off with Joe's right of use asset. So the question has told us in the additional information, your rate implicit is 10.25%. And they've also given us the payments for the 5 years, escalated each year with 6%. Okay. So if we do then a present value calculation of that, okay, it will give you 907,272. Okay. But you will remember that was then entered into that will be the present value at 1 Jan 2019, the date that we entered into this lease. 1 Jan 19. Yeah. So obviously to get it from 1 Jan to the 30th of June, there is 6 months amortization. Okay. And this is a 5 year lease. So we divide the asset by 5 years, multiplied by 6 over 12, and that's going to give us the amortization and the carrying amount of the right of use assets. Okay. So we know at the end of the year that right of use asset should not be there. Okay. So if we go onto the solution, just to show you what they've done. If we then go to our other intangible assets, no, where are we? There we go. Right of use assets in our investment property, we take it out, okay, because it shouldn't actually be there. Okay. Then in addition to that, we say, okay, well, from Rob's point of view, Rob has an investment property that's recorded fair value. So they told you that the fair value at the date of the transaction was 2.7, and we had a 50. So let's just go back to the question. They've told you here that the fair value, okay, on the date of the lease was 2.75 million. Okay, and obviously there was an estimated useful life of 25 years and the residual of 500. But then the fair value increased from 1 January to 31 June by 50,000. So if we check our solution, there's a fair value increase of 50,000, which means at the end of the year, the asset was sitting at 2.8 million investment property in Joe's books, in Rob's books. So again, we've said, okay, well, we know that shouldn't be there. So in our investment property, we eliminate or we take out this 2.8 million. Okay. Now the next part is to say, okay, well, at group level, okay, we've already agreed that this is owner occupied. Okay, which means that we apply IAS 16 and there will be a depreciation calculation. Okay, so they've given us the carrying amount given to us of 2,750. That was the carrying amount given to us in the question. Where were we? There we go. They said the fair value and carrying amount was 2,750, and we've got 500,000 residual value for 25 years. So if we calculate the depreciation, we'll go 2,750 minus the 500,000 divided by the 25 years for 6 months. Okay, remember from January up until June that year. So our depreciation is then 45,000 Rand, which then gives us the carrying amount of 2,705. So what we're saying is the right of use asset doesn't exist anymore from a group point of view, neither does the investment property. What it should be at group level is owner occupied. Okay, so if we check our solution under the PPE section, here we go, intergroup transaction 2705. Okay, so we reverse the right of use asset, we reverse the investment property, and we bring in an owner occupied I-16 asset. Okay. All right, so guys, let's just check that we work through all of the information in the question before we start playing any further on the solution. So here they tell you that the office and factory buildings on which rental is earned is classified as investment property and accounted for in terms of the accounting policy for the group to recognize investment property according to the fair value model. And we elected to early adopt IFRS 16. Okay. All right, so that's cool. That's pretty much all of the information that they give us on that. Now, if we go back to our solution, okay. So remember, we've said we have control over this particular entity. Okay, and so when we journalize, when we have control, we have to journalize the Y. Right. So let's just make sure we haven't missed anything. Share capital will eliminate. Retained earnings will eliminate. Okay. There is a revaluation surplus of 800,000 that we did on the plant. We've calculated that already. Okay, so that should be sitting in our PPE. Okay, what you guys would see that they've done, and maybe let me take you back to the solution. They've lumped everything into one big number. Okay, but what I've done here for you guys, I've split it out between the plant and the intangible, the revaluation of the two. All right, so we had a fair value adjustment of 800 on the plant and the intangible of 500, which is 1.3 million. You'll see that number coming through in the solution. Okay, so if we want to calculate, well, what is the carrying amount of these items at the end? Okay, so the carrying amount as at 30th of June will then be your fair value adjustment minus your depreciation for year 1 and year 2. And we do the same with intangible asset. If we sum these two together, guys, you'll see it gives you a total of 1095. Again, I've only done this for you guys so that you guys can follow the solution. What you'll see they've done in the solution is they've lumped this 1095 carrying amount as at 30th of June 2019. They've lumped this into one big number on the solution. So here you see a 1095. Well, that's where it comes from, guys. Yeah. All right. And then this factory building. Okay. So we did the factory building and we said that there was an intercompany profit. So if we took that intercompany profit that is sitting in the cost of the asset and we minus the depreciation that's already realized, okay, carrying amount of the factory building. So we have the intercompany profit of 315 and we've said, okay, well, we've already realized 13,125. There's a 301,875. And that is sitting in your PPE, but that shouldn't be there because that's intercompany profit. So that gets eliminated, 301,875. Okay. So we've covered the revaluation surplus. We've covered the intangible of 500,000, where we've calculated, well, what's the carrying amount at the end of the year. The revaluation on the factory, we've calculated that as well, because remember, we would have written up the value of the asset, okay, by 175. Then, of course, guys, we get to the point where we then eliminate our investment. So our 12 million bucks invested into them should be eliminated, 12 million bucks. And then lastly, there's the goodwill that we calculated that should be here somewhere, 1.77 million bucks. Okay. And then here you'll see that there's all these calculations that they've done, but we've got those on our analysis. So that covers how we get the right of use asset, what the right of use asset is at the end of the period after the amortization. There's also the revaluation on the plant and how they get the 1095. I've showed you guys that already. Yeah. And then, of course, the factory where we had the intergroup profit. Now, I know they do all of these calculations. How I've done it, I've literally said, well, the profit was 315. Okay. So I suppose it's a shortcut, 315,000. And we've already realized 13, I think it was 127, whatever that number was. Let me just go back to my workings. 13,125. So what is sitting currently in our PPE that is inflated is 301,875, which is effectively this number here. I've just taken, I suppose, a slightly more stretched way of calculating that. Okay. Then if we look at our deferred tax calculations, okay. So the 49,000, we've already calculated that as the tax on the revaluation. And then if we have all the other taxes on the sale as well as what we've realized, the total of the tax on the factory building comes up to 37,485. Okay. And that's how they get, I suppose, this 37,485. Yeah. Just want to run through the solution to make sure I haven't left out anything for you guys. Okay, calculation of goodwill, we've already done that on our analysis. Okay, so that pretty much covers then part A with specifically related to Rob. Now, guys, I think there were some trickies in this part of the question, specifically when we were looking at the lease. Our best advice that I could give you would be, guys, isolate. Okay, so like we did now when we went through the solution, ask yourself, well, what has one party done? What has the other party done? If we ignore this transaction, what is it from a group point of view? And then just eliminate what both parties have done and bring in what it should be. Okay. I think also the other part of the transaction where they sold the property onto Rob, so they revalued the property at first and then land up selling on to Rob and making this intercompany profit. That would have also been quite confusing for somebody who, you know, is maybe seeing something like this for the first time. All right. I'm feeling like there's something else that we haven't quite touched on yet. No, I think that's that. Okay, so if we look at the plant of Rob, guys, the plant, how they get this 306,600, if you go check our calculations, when we calculated the deferred tax on the plant as well as the intangible for that off-market component, the total of the tax for those two comes up to 306,600. So that's how they get that. Okay, and then yeah, so that's a 306,600. I've spoken to you guys already about how we get the 37,485 on the deferred tax. Yeah, so that pretty much then covers the full scenario on Rob. Guys, I would suggest if and there's a strong possibility first time you would have tried this question, it might not have gone so well. What I would suggest is try it again because the principles are they're tricky if you haven't had practice, but it is a really good practice question to see if you can see the bigger picture and what things should actually be at group level.